Hello everyone, I'm Novalui, Head of Investors Advisory at RHB Bank. The equity markets have largely performed well in 2024 so far. It's timely to have an update for the market and economic outlook for the second half of 2024. Today, Mr. Barnabas Gan from RHB Banking Group, Acting Group Chief Economist, will discuss key global issues and provide his insights on the outlook for United States, the world's largest economy, and the second half of the 2024 outlook. Without further delay, I extend a warm thank you to Barnabas for joining us today in his maiden session of our Money Chat series. Barnabas, expectation for interest rate cuts this year has varied widely, ranging from as many as 7 cuts to none at all, since Federal Reserve decisions are heavily data dependent, particularly concerning inflation prospect. And with the inflation rate persistently above the 2% target, what is our perspective on the US economy, especially considering the possibility of higher for longer US Fed rates extending into the year end?
Thanks for the question. I think it's important to note that we are currently living in a very different environment. If we compare this with several years ago, we have been through COVID, we have been through US-China trade tensions, and where we are, where right now, we have really moved past the Middle East tensions. What's important, and the point really is that with the lack of risk that we have previously seen in the past years, it is natural to actually expect a rather optimistic outlook for the global economy in 2024. So essentially, we actually expect a continued economic recovery momentum in key markets such as the US and China and selected ASEAN economies. Very importantly, we actually have advocated an overweight view strategy on equities and market weight on fixed income. And that view has materialized very nicely since the start of the year. It's important to note that key equity markets in the US and in fact just recently in China has actually rallied quite nicely despite the high for longer rate environment expectations that is actually being seen really at this juncture. Yeah, I think what's really pertinent in this current state of things really is that we are most likely maintaining our equity and fixed income strategy for overweight and market weight for these asset classes respectively, and more importantly, we are actually expecting a further rally of US equities at least in the rest of the year. In fact, if we see the year-to-date US-centric data, it has been very resilient, especially from the labor market, consumer confidence, and manufacturing activities, and our own in-house proprietary global sentiment index is suggesting that market watchers are actually in very strong risk-taking appetite that is actually naturally seen as we move past the Middle East tensions. And this basically suggests that market is adopting a risk-taking and yield-chasing position as we speak. Now, with the risk appetite supported as well as equity markets and the confidence actually being quite strong and positive for the global economy, how does this play out for the interest rates for the US? Very importantly, going to the question that has been asked, we are expecting only a one rate cut by the FOMC, and the rate cut will likely only happen in December this year, if any. If we see the latest FOMC minutes, I think it's quite clear to us that rhetoric by the Federal Reserve members is gradually and slowly, very subtly moving away from rate cuts, with some members actually, highlighting that rate hikes is necessary if the data calls for it. This is not seen in past statements, and this basically suggests to us that the market spirit, at least from the rate hike and rate cuts perspective, at least from the global economy and investors' point of view, will likely slowly and gradually move away from rate cuts into potential rate hikes, if necessary, into the rest of 2024. This is really not likely to dent market risk appetite as well as confidence, simply because the lack of rate cuts, for that matter, it's a function of a favorable US and global economic backdrop. And it is also very much driven, by inflation problems and inflation risk that is also largely due to demand-driven arguments. So I think, in fact, if we see inflation likely picking up with commodity prices picking up, in fact, with China, that is actually rallying quite nicely, with base metals prices rallying very nicely. This essentially suggests, that overall, the inflation will likely stay high, and the FOMC, rate cuts will likely be less than what market is expecting at around 2 rate cuts this year.
When it comes to talking about the global economic outlook, we can't avoid from talking about geopolitical tension, including those in the Middle East and the ongoing Russian-Ukraine conflict. How might this issue affect the global growth? As a follow-up, then can you also explain a bit more on the impact of the energy prices?
Yes, I think so. Essentially, if we hear the first question, base case is really that global risk appetite will likely remain in risk-on mode. But this is very much assuming that there is no further escalation of Middle East tensions. Yeah, we continue to adopt an optimistic outlook for the global economy for this year. And of course, the recent escalation in the Middle East, basically, if since it has already died down quite drastically, but it still spells two probable scenarios. If it escalates further, we think that the base case is for tensions to stay isolated within the selected members of the Middle East, and that basically suggests that collateral damage might be limited to the broader region and to the group of seven G7 members. And in this scenario, I think we discount the probability of further escalations between Israel and Israel and Iran. And basically maybe both sides taking a defense that what we are seeing already right now. Which has shown that the base case is coming and materializing quite nicely. As we speak. The second and more risky scenario, whereby we don't think it's going to be a base case, is further escalations of the current tensions, and that is a tail end risk at this juncture. Really defined as the tensions really spreading into the broader Middle East region, and with a greater form of military approach that that this scenario actually paints. So I think overall, we are most concerned about potential escalations in US and China trade tensions, really owing to the sizable exposure to US and China, and we do not discount, the possibility of collateral spillover effects from other tensions such as Russia and Ukraine or the Middle East if they escalate further. Yeah. So in short, I think we have to actually take a cautiously optimistic outlook into the geopolitical arena, and this has been a very much if you see how historical evidence have performed, a rise in tensions, at least in the Middle East as well as in other parts of the world, has the tendency to lift oil prices. If you go back to the question, and and really from the Russia and Ukraine perspective, if you see from an empirical point of view, oil prices from intraday trading has actually rallied, as high as $140 a barrel during that period of time. That basically suggests to us that there is potential for crude oil prices to actually rally even further from current levels right now, on the basis and on the assumption that tensions escalate further in a given time.
Barnabas, one of the key asset class that has been the highlight is the gold prices. I think to some extent is also attributed to the geopolitical tension. Could you explain to our audience the factor driving this strong momentum in gold prices and how you expect them to trend given the current global economic and geopolitical climate?
Thank you. It's important to further define the question. Yeah. The question is, how would gold prices trend in the next in the next 12 to 24 months, perhaps, given our assumptions for geopolitical tensions and the global economy. Importantly, I think our assumption is for political tensions, hopefully, to stay where they are right now, status quo, and that means that market watchers will likely move away from risk premiums into gold and really look at gold as a quasi currency. Gold is essentially priced in the greenback, in the dollars. Yeah. And if we see how dollar prices and the DXY trend, a more expensive DXY, a more expensive US dollar will mean a cheaper gold, simply because of the exchange rate, transaction point of view and how it impacts gold prices. The issue is this: if we are going to expect the Fed funds, the Fed funds rate to stay where they are from now to the end of the year, with the potential risk of a hike, if inflation goes up, that basically means that the implications will be a more expensive DXY, a more expensive greenback. Yeah, and that essentially means that gold prices from now to the end of the year probably means that gold prices have reached its peak, and with dollars actually getting more expensive as the months goes by, the gold prices will like to trend down into the rest of the year. That will be the base case. Into the next year, in 2025, there is a chance for Fed funds rates to cut further, if there is any, about 2 to 3 times next year. And that will actually take away, the yield chasing behavior and the yield chasing demand into the dollars. And in that case, we could actually see a weakening dollar backdrop in 2025. And that means that there could be, some upside bias for gold prices. So think of it as like a V-shape, trend for gold prices on a base case, spectrum. If we have to factor in political tensions, that's where, the assumptions will be thrown out of the window. Yeah, because we believe that gold prices will be and has been the preferred safe haven asset across all safe havens in geopolitical tensions scenarios. So we have to factor that in the event if there is any further escalation of political tensions around the world, then we have to assume a higher gold price from the immediate point of view.
Thank you, Barnabas, for sharing your insight today, which has helped frame the economic and geopolitical landscape on the global stage for this year. Let's now turn to our next speaker, Mr. Toon, Chief Investment Officer of RHB Asset Management Singapore. As noted, the global equity market has generally performed well, but the standout has been the emerging market, particularly China, which has shown impressive performance so far this year. Toon, thank you for joining us again to share your insight for the second half of 2024. We find ourselves at an extremely interesting juncture in the Chinese equity market, which have seen performance improvement over the past 3 years. From February to April, HSCEI index surged by more than 20%. Unfortunately, many investors miss out on this robust rebound. Could you share with our audience what drove this strong recovery in the Chinese equity market?
Okay. Morning, Nova. Thank you very much for inviting us back again. Nova, you're quite right. I think China is in fact one of the strongest performing markets in the world at this point in time. And indeed, it dipped in the first 2 months of this year before staging a very, very strong rebound after Chinese New Year and until now. So one of the key drivers of this very, very strong recovery is perhaps the recognition of policy changes that has happened over the course of the last few quarters. As you can see, the overall central government focus has moved from the previous common prosperity emphasis to now the focus on economic growth and even support to the equity market as well as the property market. And in fact, in terms of the property market policy changes, it has been the most significant. There was a significant end to the tightening policies that we have seen from the second half of last year to now. I think the policies are, in fact, quite stimulating. The other key driver is also the cheap valuations. In fact, at the end of this Chinese New Year, I think the Chinese equity market were, in fact, cheaper than the COVID lows that we saw in April of 2020. So, coupled with these two very, very strong reasons, one, significant policy changes, and two, very cheap valuations, the very light positioning that investors had in China actually exposed them to the sharp rally that we saw post-Chinese New Year. As you can imagine, international investors have been selling or cutting China positions overall over the last 2 to 3 years. Domestic investors were in fact selling before the Chinese New Year in February. So when the realization of that the policy changes was very significant, a lot of these investors, in fact, added to their positions in China. So I think these are the reasons why we saw a very, very strong recovery in the Chinese stock market after the Chinese New Year this year.
But the pressing question here remains is, should investor now still a good time to buy into China? Despite recent gain, I know that the Chinese equity market is still lower from where they started 3 years ago. Do you think that this recovery in the Chinese equity market is sustainable, or could it be just a trap for investors? Please share your thoughts, Toon.
Yes, these are indeed very, very good questions. And in fact, very, very relevant to investors who are thinking of jumping back into the Chinese stock market. I think the short answer is yes, we do think that this recovery is sustainable. And I think the main reason that I would cite is that there has been very, very significant policy U-turns from the third quarter of last year. Like I mentioned earlier, I think the emphasis from the most senior leadership of the Chinese government has pivoted from common prosperity to now the focus on growth. And more importantly, from February of this year, we saw very, very clear signs that senior leadership in China were in fact very, very supportive of the equity markets. And that's in addition to all the policies they have implemented in order to buffer the Chinese economy. Perhaps the most key policy change has been the one that is related to the property market. So the property market policy change has been to demand stimulus. And this demand stimulus can be seen even in key first-tier and second-tier cities. I think we are still early days yet because the Chinese stock market has been weak over the course of the last 3 years or so. And the other thing I want to highlight is that we expect earnings to improve over the next few quarters as consensus starts to revise up the earnings of all these Chinese companies. So we are also expecting consumer sentiment to start to turn up from the second half of this year. Arguably, the market has been very slow to appreciate the changes that has been happening in the Chinese stock market. My view is that the US-China tensions is here to stay. And in fact, this year is a US presidential election year. So which means that temperature will also start to heat up from probably the second quarter of this year. However, all these are not new news. So in fact, the US-China tension has been going on since the Trump administration. And right now, it has carried on throughout the Biden administration. And in fact, Our view, once again, is that I think the US-China tension is here to stay, right? So in terms of our stock picking, we are embracing, in fact, this US-China tension, and in fact, trying to find stocks, companies, and sectors that will benefit because of these US-China tensions. And going back to the recent tariffs that were implemented on Chinese imports into the US, our view is that it's mainly symbolic and not significant. In terms of the Chinese EVs that are imported into the US, the volumes are in fact insignificant, accounting for less than 1% of total EV exports from China. If you were to look at the overall tariffs that have been impacted by the 14th of May tariff hikes, the value is roughly around US $18 billion. In our opinion, it is still relatively small because it accounts for roughly 0.5% of total China global exports.
I trust that our discussion on emerging market would not be complete without your general perspective on the Asia-Pac ex-Japan market. Could you briefly share your view on this region as a whole? And perhaps highlight some other market within Asia that you favor aside from China. For example, like India or ASEAN perhaps. Will you continue to be in favor on the China +1 strategy?
So apart from the Chinese equity market, we do like India. However, in the near term, India looks to be expensive on a valuation basis. Indeed, India exhibits very exciting growth prospects. And in fact, Modi's re-election will provide a very, very strong platform for consistent growth and consistent policies as well. These are some of the key attributes of why investors like India in general. However, once again, our view is that India is exciting, but it's slightly expensive. We also like ASEAN as well. It's indeed very, very cheap. And in fact, will be a beneficiary of China tourism rebound as China tourists starts to travel overseas post the end of zero COVID. However, our view is that ASEAN has certain domestic headwinds as well in terms of politics, as well as the pressure on currency. We continue to like Taiwan because of its technology focus. As you can imagine, AI and technology stocks are in fact very, very well sought after by investors. And Taiwan being very, very technology focused is indeed a key investment destination for investors, both within Asia as well as globally as well. Going back to the point about the China +1 policy, I do think that India and ASEAN will indeed be favored destination for the China +1 strategy. However, I would like to note that it will take time for India and ASEAN to take the place of China. It's not easy to substitute China in the shorter term. And if you think about it, the size of the Chinese domestic market as well as the size of the Chinese workforce makes it very, very difficult for any country in the world to actually take over China, even in the medium or long term. So, however, it's important to note that what has happened on the geopolitical front means that this China +1 strategy is a structural change for investors investing into this region.
Thank you so much. That is Toon from RHB Asset Management Singapore. We have a lot that we need to cover in this Money Chat series. So if you have any questions that you want to ask either Toon or Barnabas, please feel free to put the question in our chat box below. Our speaker will try to address your questions as soon as possible. Next, let's hear from Encik Muhammad Fauzi bin Muhammad Tahir, CIO of RHB Bank Malaysia, on the domestic market in Malaysia. Fauzi, we have seen some recovery in the Malaysia equity market. Do you see this trend to continue for the rest of 2024?
All right, thanks, Nova. Actually, what we were quite positive actually on Malaysia market since the beginning of the year, until towards the end of the year, and then we saw some positive development actually developing in the market. From the chart, what we can see, Malaysia was the best performing in ASEAN, and other ASEAN markets were lower, and Thailand was negative year to date. The index has gained around 11.1% year to date. Furthermore, I think the rise in the index was also supported by the high market volume. We remain positive on Malaysia market as we believe the market will be supported by the improving economy and also better corporate earnings. As what you can see from the chart there is a nice trend actually in the corporate earnings for this year. We believe that the positive market trend could be sustained as long as the macroeconomics and the corporate earning performance remain positive. We also think that the positive catalyst in the local market to continue due to the structural reforms announced by the government to achieve long-term sustainable economic growth. For example, the Madani Economic Framework, the new Industrial Master Plan 2030, and the National Energy Transformation Roadmap are positive for the economy, and the improvement in the bigger picture bodes well for corporate Malaysia earnings outlook. I think coupled with that, ringgit has also shown some stabilization for now and has performed better against other currencies in the past 3 months, despite external negative news. So this will be positive for the local market. As foreign investors, we think will have more confidence to invest in Malaysia besides local strong liquidity.
We have heard a lot of interesting announcement on the global tech companies investing into Malaysia data center sector, such as from Microsoft and Nvidia. Not to forget also the conversation that PMX had with Google recently. So how does a fund manager capitalize on this trend for the portfolio under your care?
So for the data center, the market is expanding rapidly, driven by the demand for cloud services, the Internet of Things, and the adoptions of other emerging technologies such as the artificial intelligence. So Malaysia will benefit actually due to the ample supply of power on the generation and as well as on the grid side. So I think for the portfolio manager, we position actually into the utilities companies, into the constructions companies, and also into the property companies which has these characteristics. And also, I think besides ample supplies of power, land is also important for the setup of the data centers, and Johor especially has abundant land for the data center to flourish, and also its proximity to land scarce Singapore. So I think that benefit most of the properties companies situated in Johor, and also I think the constructions companies actually that are based in Johor as well. And also I think another factor is the United States China strategic competitions, which has put cooperation from China and the West to diversify and expand in Southeast Asia in the semiconductor and digital infrastructure space. So I think Johor especially has the infrastructure to provide amenities for these companies to be set up in Johor itself.
Fauzi, you have spoken a bit about Johor. I trust that the stories about Johor doesn't stop at the data center. So can you give some quick summary of other key events in Johor and how would it benefit Malaysia equity market as a whole?
Johor, I think now the focus is on Johor because due to the Iskandar Malaysia Development Corridor that sought to encourage investment in higher value sectors, including electronics, healthcare, and financial services. So these would help the economy and also generate more employment. The development of digital infrastructure and construction projects in Johor should provide positive sentiments towards telecommunications, manufacturing, technology, utilities, construction, and property sectors. And also, I think Johor, because of its close proximity with Singapore, lead to the initiative for the jointly developed a special economic zone with Singapore will also help the country to achieve better economy going forward. And I think the property company would likely to benefit as job market improve, as the SEZ will be among the investment catalysts for over the medium term. Then the other thing also I think is the upcoming projects in Johor, like the cross-border rail link designed to alleviate traffic congestions at the Johor-Singapore Causeway will also encourage property take-up rates. And then I think the development over the HSR also, I think that will also encourage construction companies, and then that will also help I think the property companies to launch more projects actually for them. So I think that will encourage, or that will alleviate, or that will stimulate actually economic activities in Johor especially, and also along the HSR rail link.
Fauzi, despite the local equity market has been doing relatively well, however, we continue to see outflow from the Malaysian equity market for the first half of 2024. Why is the outflow occurring?
Okay, let me explain in two parts actually on the outflows of the foreign investors. From what you can see from the chart, there are two charts actually. The first one is the foreign investors were net seller of the market as at April 2024. And then the second chart is the weekly foreign investors flows since the beginning of the year. What we saw actually, foreign investors have been net seller of Malaysia equities for the first 4 months of 2024 on the expectation that US Federal Reserve may not cut its interest rate soon, and expectation of a reduction in the number of the rate cuts in 2024. However, the selling pressure has been fully absorbed by local institutional investors. The positive observations that we saw is that the foreign investors have started to come back to Malaysian market from last week of April. This we think would be positive for the index to trend upwards. I think the upward trend to continue. And also what we saw, foreign investors continued their net buying trend for the fourth straight week until 17th of May 2024. So foreign investors have now turned net buyer actually of 2.86 million year to date. They have cumulatively net bought close to about 3 billion, I think, since last week of April. So for the 4 weeks actually from the end of April to 17th of May, they have bought about the 3 billion of Malaysian shares actually. So, but local institutional investors continue net sell trend, but remain net buyer year to date of about 3 billion. And also the local retail investors were the largest net seller year to date, amounted to about 3 billion. What we think also, like what I mentioned initially, I think the ringgit has shown some sense of stabilization. So we expect investors' sentiment should remain strong as headwinds from higher US interest rate and the stronger dollar are expected to ease for the ringgit. So ringgit, like what I mentioned, ringgit has strengthened by about 2.14% for the past 3 months and outperform other countries in the other currencies in the region. So what you can see from the chart there. I think that gives some confidence actually for the foreign investors to come back to Malaysia.
Thank you, Encik Muhammad Fauzi. As Malaysian investors, many of us have exposure to our home country market, whether through mutual fund or direct share investment. I hope Encik Fauzi's insight have provided you with a better understanding of the prospect in the Malaysian equity market. Thank you, Encik Muhammad Fauzi again. Moving on to our last speaker for this money chat, Mr. Michael Chang, CIO of Fixed Income RHB Bank Malaysia, who will share his insight on fixed income with us. Michael, while I understand that Malaysia's interest rate trajectory will likely correlate with the US Fed rates, however, it may not synchronize exactly in the timing and momentum. How many times of interest rate cut do you expect in Malaysia to happen in 2024? Or would it like more interest rate cut that we can see in 2025?
So for Malaysia, we're not expecting any rate cut for Malaysia this year. And I think whether the outlook is for 2025, whether there's only any OPR cut, I think we need to watch the inflation numbers for Malaysia. But so far, what we have seen, the backdrop is quite different for Malaysia against the US, as inflation is coming off and on a much lower base. In terms of what are the factors that will be considered in terms of the inflation outlook will be the recent government policies, such as the planned fuel subsidy rationalization, increase in civil servants' salary, and introduction of the EPF account tree, are likely the trigger for inflation to float a bit higher. So as a result, I think BNM is likely to adopt more of a wait-and-see mode and remain vigilant of any potential second-round inflation effects, if there's any. In the last MPC, they have guided the domestic inflation to range between 2 to 3.5% for full year of 2024. So based on these factors, we think that there will be no change in terms of interest rate for 2024 and OPR, overnight policy rate, to remain at 3% for this year. Whether there will be a cut in 2025, I think it has to look at a few factors. One of them would be the global growth, and then followed by the Malaysian growth, and also the inflation path that we're going to see in 2025. A lot of this subsidy removal, fiscal reforms is likely to be carried out in the second half of this year. So likely there would also be some, flow-through effect to 2025. So we remain watchful of what the inflation path is going to be for second half of 2024 and also early 2025.
In the Malaysia unit trust industry, we observe a good inflow in both global and local fixed income fund. In your view, which one would you prefer between global or Malaysia fixed income investment?
To talk about that question that you just mentioned, Nova, in terms of what's our preference, whether is it US or Malaysia fixed income, US has actually a more inclination to also cut interest rates if US growth were to slow. I think this is also something that is likely to take place in the next 3 years, while BNM has actually been maintaining OPR because of various reasons also, like we mentioned earlier about potential inflation, fiscal reforms and all that. So the capacity to cut, if you compare to these two countries, definitely US has more ammunition, more power to also cut interest rates compared to BNM because of the magnitude of the current Fed funds rate versus OPR are also very different. So the divergence in terms of interest rate policy will be there, coupled with the higher starting rates that you're seeing in US, and therefore that will actually translate to higher returns because when at a much higher level, when you cut interest rates to a lower level, definitely the bond price will jump more than a country like, for example, Malaysia, that has actually adopted a more steady interest rate path, then because the cut will be much less, so the price jumps will also be much less compared to the US. So investors should also consider other factors like besides returns, because you need to also look at US bond market being a more volatile one, because comparing US and Malaysia, Malaysia has a more stable fixed income market. And in fact, when we talk about 2022, when we had to go through hikes in terms of interest rates in the US and then also Malaysia in that context, the brunt of the selling, the volatility, and then also the losses was actually higher in the US compared to Malaysia. Malaysian fixed income is somewhat more in terms of risk-adjusted return, its risk is lower. That means returns are also higher on a risk-adjusted basis. So if you are investing in US and you are also a Malaysian investor, then you need to also consider foreign exchange. Whether do you enjoy the rate cuts and then you have a high bond price in US bonds, but then at the same time, you could also see potential erosion in value because of foreign exchange, because the likelihood when interest rate cut, the dollar will also weaken.
Michael, the interest rate cut are anticipated to happen either sooner or later anyway. So investors are looking to position their portfolio to benefit from the potential interest rate cut earlier. Besides fixed income, is there any other strategy, example like REITs or dividend-paying equities, that investors should consider?
So for investors, if you're talking about possibly a combination of a fixed income and those REITs or dividend equity, I think you can do that and embed that into a portfolio. Typically, when we do this, we call it a mixed asset or balanced funds, driving the two strategy together from bonds and also high dividend paying stocks or REITs. So if you're looking at a high dividend stock or REIT, you can actually sort of relate that to a perpetual with income that is long-term and then also without maturity, because essentially, when we're talking about stocks and REITs, there's no defined maturity, there's no actually principal at the end to be paid, but essentially the capital that you invested, you are looking for consistent income stream in the likes of REITs or big cap that is on a very consistent dividend strategy. So you can combine this to a fixed income with bonds, and that portfolio will mimic a long-term income proposition. Within the fixed income space, you can also consider something that's of higher return, of course, comes with higher risk, and that's where we look at potentially global high yield or Asian high yield to get more returns, because at this juncture, given that the whole interest rate globally, it's also higher, it makes also sense to look into global high yield or Asian high yield if you can take that risk. But generally, investors that has a certain more moderate risk profile, they will actually go for investment grade bonds, don't have to take so much risk for that simple reason. You can already get decent returns, lock-in returns, given that the base rates, the current interest rates are already at record high compared to past decades or so. If you look at where Fed, in terms of current Fed funds rate is a lot higher than more than a decade ago. Bonds works best in a stable environment for interest rate, or there are cuts that are coming in the next 3 years. Thank you, Nova.
Michael, when it comes to the performance of the equity market this year so far has taken the center stage. However, there is still interest for investor wanting to go for the safer investments such as fixed income. However, there is some concern, example like the Chinese bond market, especially when it comes to the bond in the property sector. Can you share your thoughts on this issue? Meanwhile, do you see the similar concern in the Malaysia's property bond market?
It's a tough question to start this on this. I mean, generally the outlook for Chinese property sector is never an easy question to handle. I mean, in general, the bond market, if you're talking about Chinese property, it remains weak, as sales are still not as what investors expect to be, or have they recovered to a level that is considered that is palatable. So while the Chinese government has actually increased policy support, there's still a lot to be done to alleviate home buyers' concern, as project completion risk is still a factor that's having in the minds of Chinese property investors. But of course, the overall confidence and expectation has somewhat improved because of the recent ammunition that the Chinese government has actually try to stabilize the market. But I think the key question is whether what they have done is substantially and enough to actually drive the Chinese property market to recover faster and a more resilient one. Coming back to Malaysia, while I think is talking about property, but the two markets in terms of property are very, very different. Of course, Malaysia, in terms of property market, it started off on a softer side, post-pandemic effects. I think we all understand why as such. But I think in terms of the recent rebound in the property sector, we are actually seeing some good numbers. We actually see the improvement in terms of Malaysia's property overhang, where the unsold property has declined from a high of 36,000 in 2021. And 2023, we are seeing that about 25,000. So actually, this is a good indicator to also relate that there has been some relief in property space. And in fact, I think in the context of stocks as well, generally, key property stocks has also rebounded. The sentiment has actually improved a lot more compared to 2 years ago when we were still being locked down in a COVID-19 pandemic. So all in, I think what's happening in China, it's idiosyncratic risk because it's largely affecting China, contained in China, but it's not the same of scale and also the current mode that Malaysia property market is in. So I think this is where I think we as investors needs to distinguish the two markets. And in terms of bonds, I think we will be more inclined to sticking to the big names in terms of property that issue bonds. That will be the main driver in terms of getting income and also some you try to actually also limit your exposure to higher credit risk. So stay to big names in terms of property names, and that will be the strategy that we would like to suggest for investors.
Thank you very much for your sharing today, Michael. That really wrap up the total so-called our sharing for the second half of 2024, which includes the equity market outlook and also the fixed income market outlook. Thank you to all our speakers today. Investing is a continuous journey, and RHB Bank is committed to provide insight through our Money Chat and podcast series, accessible from the RHB Merge website. If you have further questions, please consult with RHB Bank's Premier Relationship Manager to discuss how best to position your investment portfolio to meet your financial goal. We look forward to seeing you again in our next Money Chat series.